Welcome back, guys. In this video, we're going to talk about employee stock options. Now, I put this in the business ownership section rather than the stock section because this acts a little bit differently than just investing in the stock market because you're very much invested. This is the company you work for. You are driving growth, right? You are pushing it forward. And so to me, it fits more in the business ownership. Like you have a real vested interest in the success of the company beyond your salary, and you are contributing to its success. And so you have a lot more information. You have a lot better idea of its trajectory, of its growth potential, whether you believe in it or not. So I want to put it under here. This can be obviously a significant portion of your wealth building pathway. If you get options in a company and stock or equity grants in a company at an early stage, that can pay off to the tune of hundreds of thousands, if not millions of dollars. And so it's important to understand how they work, what they do, and pros and cons and everything like that. These are pretty confusing. And so I'm going to break these down into individual videos so that you really understand and can come back and get a quick recap if you get confused at any point. Okay. So we're going to start just at the very beginning, right? Ownership in your employer company is still ownership. And what's powerful about that is now you have skin in the game. It's similar to earning a compensation based off of performance, right? You might have a salary and then a bonus based on performance. If you are in sales, for example, and you go and you pound it and you hit your quota and you exceed quota, then you get a disproportionate share of that revenue that you're driving. It's all the system is based to incentivize you to continue to work hard. In non-revenue producing roles, non-revenue directly facing producing roles, maybe that bonus potential is a little bit lower, right? And your performance is a little bit more vague, but based on different metrics. Well, in this case, when you own equity in the company, that equity is directly derived from the growth and the valuation of that business, period, no matter what your role in the company is. And so it's very powerful. You have skin in the game. You want to see it succeed because you have a vested interest in its success. Okay, that's why these can be so powerful from a business standpoint, offering these types of incentives to their employees, and from an employee standpoint to really make the most of it because you can get more than just a salary or a cash compensation. So a couple things to think about when comparing job offers, though, and comparing compensation packages. Oftentimes, you might get an offer and one has a higher salary, but maybe a little bit of stock options, some stock grants. Maybe another one has a much lower salary, but a higher percentage in equity grants. Okay. How do you choose between the two? It's difficult. Obviously, there's a lot of factors, but just some things to keep in mind, right? Cash compensation is valuable to you now, right? If you have a higher salary, that means you have a higher salary, period. That is all going to come to you. It's locked in. Value doesn't fluctuate. Your salary is what it is, or your cash compensation is what it is. On the flip side, equity could pay off, but it might not. Essentially, you are getting a grant of equity, and you can cash in on a future value of that equity at some point in the future, depending on that future value, up or down. And so you could be working away and get equity, and then that equity be worthless, right? The company doesn't do as well, and the value drops, and then what are you going to do with it? So it's not guaranteed, right? And that's part of the risk. Just like buying a business, just like starting a business, the returns are not guaranteed, okay? We're past the stage of guaranteed. If you want to go for growth, then you have to take some risk. You've got to have skin in the game, okay? So stock could go really well. It could not do well, and then you're on the hook for it, right? And maybe you should have taken the all cash compensation offer from the other position. So it all depends on you, your belief in yourself, and obviously your role, the company, what it does, the growth trajectory of the company, on and on, right? There's a lot of variables, but just know cash is guaranteed to stay in value, obviously minus inflation. Equity compensation fluctuates. Could be higher, could be lower, could be much higher. If you get in on a lower level startup and you're taking more risk by joining a startup at an earlier stage, more risk because the equity might end up being worthless. But you also are getting in at an earlier stage where the growth could be that much greater. Everybody wants to be, you see the success stories of these companies that, become unicorns and then IPO or get acquired or whatever. People that were early stage employees that believe in the company, they believe in the vision, they stick it out over the long term. They are compensated if they have the options, the equity grants and things like that. They're compensated disproportionately based on the amount of risk they take. When you join a company at a later stage, when their growth is more or less secured, it's not guaranteed, but they have the trajectory, they have the finances, the model, they're growing steadily. If you're going to join that company and get in at that level, then you're not taking as great of a risk. There is still some risk, but not as great of a risk. And so your reward will not be as high, right? That's just how it works. Risk, reward. We've talked about this a lot before. So as you're evaluating compensation packages and things like that, factor in the cash compensation now or bonus or commission. Factor in equity compensation. Say, is this valuable to me? And then also, depending on the vesting schedule, which we'll talk about in future videos, but that's essentially the timetable that over a number of years where you actually get the equity. They want to keep people around. They want to limit turnover, and they want to give you an incentive to stay and continue to work for the company, continue to push and progress in the company. And so if you don't envision yourself being there for 2 years, or a max of 2 years, but your vesting schedule is 4 years, you realize that you're going to leave half of those grants on the table anyways if you left. And so maybe the equity grants are not as important as cash, right? So there's a lot of factors there, but I kind of wanted to cover some of those things that I just want you to think about and approach equity stock options, employee stock options in that way so you can make really, really good decisions, knowing what you're going to get. It could fluctuate, knowing the risks you're going to take, and then making a decision going with your gut. Okay, so we're going to cover the different types: RSUs, restricted stock units, ISOs, incentive stock options, and then ESPP, employee stock purchase plan. I'm going to cover those three. There are other different types of stock options. These are the three most common I'll cover in these coming videos. All right, guys, see you soon.
Great decisions balance risk, reward, and belief.